What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we're kind of just breaking down all of the madness that has happened over the last week and a half so in the economy, in the world here. We're going to be looking at the Middle Eastern conflict going on. We're going to talk about rate cuts, talking about oil prices. We're talking about unemployment, Jerome Powell, you name it. It's on this docket right here for today. So if you're excited for today's video, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. We're going to get right into it, and I'm going to have this organized the best of my possibilities that I can, just because I have some things on the browser, some things on Discord. So we're going to talk about some things about what's going on here. First things first, one of the most important things that came out in the last 24 hours is a ceasefire between Iran and Israel. Now, again, I'm not here to push any political views. I'm not here for that aspect of things. So if you're here to put political views in there, that's not what we're here for. We're looking at articles, data, and what it means to the economy, because the economy is where you make your money, right? So full disclosure, no political affiliations here. We were talking about here as a result of that, just so we're all clear. And also not a financial advisor. I know you guys already know that. Anyways, so we have a ceasefire that has been pushed out into the news here between Iran and Israel in the Middle East conflict, which is good. When this whole thing first started, markets started to freak out and have a little bit of panic because war is uncertainty and it causes fear and what's going to happen. And one of the bigger things that the stock market and economists were talking about as a result of this was oil prices. Oil prices, when they shoot very, very high, it means that it's going to be some trouble coming our ways here. And here's why. We're going to break down oil prices first, okay? So the most important thing is this. So again, when the whole conflict started, Wall Street started freaking out and saying, what could happen as a result of this? Bring in the Strait of Hormuz. So this is one of the world's most important shipping choke points, connecting the oil-rich Persian Gulf to the rest of the world. Around 20% of global production flows through the waterway, and Iran controls the northern side. And when things started unfolding here, people started to wonder if Iran's going to retaliate either with sending missiles back, or could they just close down the Strait of Hormuz right here? Because if you close this down, 1/5 of your daily oil production, about 20 million barrels, will not be able to get through. That is going to cause a huge disruption in oil and energy prices, not just in the Middle East, not in the US, but in the world, because 20 million barrels of oil will not be sent out in a day. Every day that goes by, you're missing out on 20 million barrels of oil. They can just close this down and say, nope, sorry, no, nothing goes through in here anymore. And then there's no oil. And now what is that going to do? Well, this is going to, if they were to close this down here, this is going to limit the supply. It's going to be a huge shock to your supply here, but people obviously still need oil because of, fuel and energy and those kind of things there. Everybody needs it. It's not like a want, it's a need in the world around us, right? So there's high demand, but you're cutting off the supply. What's that going to do as a result? Well, that's going to push oil a lot higher. So people were starting to freak out, and you might see that the oil prices, the oil futures market started having these big spikes here because, again, you have a limited supply potential. It's going to push up the demand. It's going to push prices higher for how much a barrel of oil will cost. So people were worried about that. That's a huge problem for us. And again, what I can do here is I can show you guys on Discord here. So at the Kingdom here, feel free to follow it. Here's Fridge Financials right here. So I have my own page that writes up every single thing here, as you can see. But taking a look at this little graphic here, this graphic kind of basically breaks down what happens with higher oil prices and how it relates to the Fed and Jerome Powell. When fuel prices go up, that means that it's going to be pushing up fuel, gas, diesel, those kind of things that people are buying every single day. If it pushes up those prices, people are paying more for it, which means that you're going to see that inflationary pressure in fuel and in energy and all those kind of things there. You're going to be pushing up that inflationary data that Jerome Powell doesn't want to see. Jerome Powell has been waiting and keeps saying, I'm going to keep looking at data. I'm going to keep looking at data. And if that strait was closed and they cut it off, this could have been a reality as to what could have happened as a result. Thankfully, as I said, there is a ceasefire that was come out in the news as of 24 hours ago, or a little less than that. Thankfully, that's there because this could have been disastrous. Because think about what happens. Inflation goes higher. That means people are spending more on gas and diesel and stuff like that to be able to pay for things they need every single day, which means that there's less disposable income. They have less money left over to then push into the economy. Slows down the economy. Inflation goes higher. Stagflationary period here, which we're talking about right here. Not good. It also can impact businesses because you have those 18-wheelers, you have those big trucks and corporations that are shipping with transportations, manufacturing, all those kind of things. And again, the companies may either cut margins, they could cut back on employment to make up the difference if they're paying these higher prices for fuel here and for oil. They could also just push onto the consumer if they want to, which again is all bad things. Either you cut your margins, which is bad for company outlooks. Either you scale back on operations, which means get rid of the people that are working there and you have less people working, or you push on the consumer, which is higher inflationary pressures, which is not good. So bad thing there. Again, stocks may fall, oil may rise. You might have seen the stock market have a little bit of a turmoil last week because of the Middle East conflict and everything. These are just some things to really think about as to what happens when you start hearing people talk about how oil is shooting higher. These are things as to why oil goes higher. Usually the market reacts in a negative way because people start to have this fear. So that's one thing to really talk about here. So thankfully, there's a ceasefire. And thankfully, this is not going to get closed off because that could have been a huge factor. And that could have put Jerome Powell in a worse spot as he already is at. Now, let's talk about Jerome Powell. Let's go to the FOMC meeting time here, right? And we have a couple of Feds here we're going to talk about as well. So Fed Bowman here, Michelle Bowman, supports a rate cut as soon as July, becoming the second central bank policymaker in recent days to be explicit about an easing of monetary policy in the near term. The second one behind Waller. Federal Reserve Governor Waller also comes out and says this before Bowman does. It's very interesting because now it feels like Jerome Powell is almost being pushed into a corner here where not only is Trump drilling down, hey, cut rates, too late, Powell, cut rates. Now people on the Fed are being like, hey, dude, like, let's talk about it. Now, obviously, Jerome Powell isn't the key decision maker here. It has to be a, majority. I don't know what the exact voting rules are for it, but Jerome Powell is at the helm, so he's the one who gets these articles, all this drama and stuff like that. So Bowman made the argument for such a move in his speech Monday, saying that the inflation has declined or come in below expectations over the past several months, and asserting that trade policy will only amount to minimal impacts on the Fed's preferred inflation measure. Yes. I mean, inflation has come in lower, which has been good. CPI comes in lower. PPI has been a little bit up and down here. So, but your PCE is, so then we've been now in tariffs now. We're on to the second month of having tariffs implemented here. And we haven't seen a huge shoot up in prices and a huge shoot up in the inflationary pressures and the inflation measures that we're talking about here. Your CPEs, your CPI, or your PCEs, your CPIs. We haven't seen that here. But she also cited concerns that downside risks to unemployment could soon become more salient given recent softness in spending and signs of fragility in the market. Recent softness in spending. My guess is she's referring to the retail data. If you take a look at the retail data, it was bad. Not bad, but like it's what happened here. Take a look at the retail data here, right? April was coming in negative 0.1. May was negative 0.9, which means that your retail sales have dropped off almost 1% from the previous month. And it's a huge, and again, what you're kind of seeing here, we talked about this in a previous video about GDP and stuff like that, is you're getting this whiplash effect of tariffs here, right? Why was the spending so much higher here? Well, because people are front loading because of tariffs. What's going on here? Well, everybody bought up here, so no one's buying over here. So it's kind of like a mirror image almost, right? Where it's like a lot of people bought up here. They had a lot of that, they're buying up before tariffs hit and stuff like that. They're front loading, buying wherever they can, buying cars, buying whatever. And now they get the other side, the other extreme value where nobody's buying things now. So nobody's spending money here. Everybody's holding onto their cash now because of not paying these higher tariffs here. So everybody's holding their cash. So I think that's what she's talking about, saying that there's softness in spending. Yeah, there is. The retail data came in and showed lower than expected. Of course it is. Should inflationary pressures remain contained, I would support lowering the policy rate as soon as our next meeting in order to bring it closer to its neutral setting and to sustain a healthy labor market. And we talk about the labor market as well. As you take a look at the labor market here, it is still in a relatively low period for the unemployment here. But the problem is, again, Jerome Powell talks about this idea of seeing like we're going to have a rollover period. And when the market rolls over for the labor market, that's when the rate cuts should be coming in here. And that's how we can kind of combat everything here. And you're starting to kind of see this nice little uptrend here in unemployment from November 2022 to April 2023, 3.4. Now we're rising up to 4.2. And what's even more interesting here, if we go back into the Discord here, taking a look down here, right here. This is the FOMC summary of economic projections from last week. Slower growth in the GDP compared to March. So they're looking. So Jerome Powell knows that the economy is slowing down. He knows it. He could see. They are looking at the data here. They're saying 1.4 is your GDP growth for 2025, below 1.7 from March. He knows the unemployment rate is going to be higher because, again, they're talking about it being from 4.4 to 4.5. We know also inflation is going to be a little bit higher here as a result. So the data is here for him to know. Unemployment, they are projecting unemployment to be at 4.5. Right now, as you saw, it was 4.2. So we're looking at higher unemployment here. So there's no like beating around the bush here and saying like, I don't know what the data can look like. You guys are already factoring in this idea of unemployment is going to be a lot higher. And again, Jerome Powell says, when the labor market the labor market is strong, it's strong. And whatever happens is going to happen after the labor market. And we're going to try to get ahead of that and stuff like that. And there's more to talk about here. I'm going to come back to this multiple times. Don't worry. So that's kind of what Bowman is saying here. Waller comes out and says very similar stuff. Christopher Waller said the central bank can lower interest rates as soon as next month, reiterating his view that the inflationary hit tariffs is likely to be short-lived, which is what everybody's been saying about for the longest time, is that tariffs are going to be short-term inflationary pressure values or short-term inflationary pushes. It'll calm down as it does. And so far, again, it's really early on here. July data for June is going to be important, and August and July, like all the data points coming up are going to be very, very important to know. We could do this as early as July. Next meeting is on the 29th and 30th, the FOMC meeting, which is going to be something that's curious to look at. Federal economic data shows GDP growth and inflation are running close to the central bank's targets, which is good. You want to have the GDP there and inflation basically where they want it to be at. He also says that he believes that the Fed benchmark rate is 1.25 to 1.5 above the estimated neutral level, which I think we got room to bring it down, and now we can kind of see what happens with inflation. So there's an interview that he did here that he talked about, I think it was with CNBC potentially, and I thought it was a very interesting point that he makes here. And he also talks about this whole paragraph actually is important now that I'm looking at it. And the central bank could pause cuts if needed due to a shock from events such as the crisis in the Middle East. Thankfully, that is kind of subsided, it looks like. We've been on pause for 6 months to wait and see, and so far the data has been fine. And he's right. We started cutting rates last year, right before the electionary period. And we cut rates the electionary period because our jobs data was looking really glim. It was looking really down and out. And so, we cut rates here to kind of push it back up and to keep it stimulated and stuff like that. And now we're kind of almost feeling like we're in the same kind of period again. We've been on pause now for 6 months, again, as Wallace says here. And the thing to keep in mind about for this is that I don't disagree with this idea. He's not saying Jerome Powell has to come in and drop like a 0.5 basis point cut here. You don't need a 0.5% cut here. What he's saying is saying, hey, we've been doing pretty okay for the last 6 months. Inflation's been somewhat controlled. The GDP slowed down because of tariffs, which again, makes sense with the imports and the exports and all that kind of stuff like that. But you're waiting for the labor market to roll over for you're making cuts here, and that might be too late. He just says, it's plain and simple. Let's just make a cut now and just see what happens. Say you cut in July and then you see a spike in inflation or whatever. Okay, so then you just keep it there for a while. You pause it again. You can always pause it. But if nothing is substantially changing, maybe do another cut later on, trying to get ahead before the labor market officially turns over. That's what Waller's trying to say here. And I think it's a valid point because it seems like you have two sides here. Waller's like, cut, see what happens, cut, see what happens. And Powell's like, labor market turns over. 0.75 basis point cuts to just drop the market like that. Like it doesn't, to me, that's more of a shock to the economy. If you want to have a nice soft landing, you want to do it in slow incremental periods of controlling your interest rates. So that's kind of what Waller is saying here. Now, as you will see at the time of recording this video here, this is looking at the potential possibility of a rate cut in July 30th. It's at 22.7%. And what you'll notice is that it has gone up a little bit. Obviously, a month ago, it was a little bit higher up. And I'm not sure if maybe I don't know what the reason why it was higher here. Could be some sort of data that came out or some things Jerome Powell said or whatever. I have no idea at this point. But 1 week June, and the June 17th was 16, now it's 20, now it's 22.7. So you kind of see that they're starting to get a little bit more pricing in more, maybe of a potential rate cut in July, which again, to me personally, as someone who doesn't work for the Fed, it kind of makes sense. Just drop one and see what happens. Drop a rate cut, see how the market responds. If the market responds in a bad way, then okay. The problem that Jerome Powell is facing, and it's the same thing where I've brought it before, is that he doesn't want what happened in the 1970s to happen again, where the Fed in the 1970s was being so heavily impacted by people telling them to cut rates, to raise rates, to cut rates, that nobody had credibility in the Fed anymore. And then you had to have Paul Volcker come in and just jack up rates like no tomorrow to combat a huge inflationary value that we had in the 1970s, 1980. He doesn't want that. So he wants to go off of data, which again, I'm not opposed to, but you gotta be careful here. The other thing that we're looking at here, so this was talking about, your interest rates and everything else. This is your probabilities of rate cuts here. Again, July, at the time when I screenshot this one, you were looking at only a 10% probability of a rate cut in July 30th. Now it's at 22%. So it pretty much doubled the amount of probability of having it there. Other things to take a note of, here's your dot plot. And the really stupid thing about this, it seems like what people gathered from Jerome Powell's FOMC speech last week, is that take the dot plot with a grain of salt. So everybody talks about the dot plot. I talk about it, but like, look at how spread out these rates. Like rates could be here or here. Like it's not a very, very big consensus. It's like spread out. Like who knows what's going to happen here, right? So that's why he says take it with a grain of salt. Look at it however you want. Kind of up to you, but that's the dot plot there. This was really, really good to see, though, from the FOMC summary of economic projections last week. Uncertainty and risk to GDP growth have improved. So the nice little rectangles here, these little dotted lines here, are March projections. And what you'll see is that March had a higher uncertainty than it does now in June, which is good. Again, same thing with GDP growth, weighted to the downside. Again, huge risk to GDP growth in March, a little bit lower in June. Still higher than like in the middle. You want to be like over here potentially for GDP growth, right? But the fact that it's coming down means that it seems that the Fed has a little bit of a better understanding, hopefully, of things. They do the same thing for unemployment. They have a little bit better of an understanding of unemployment, which is great. And the one final thing here that I want to say, and I want to say that I watched Kevin on YouTube who brought this up to me, which I never even knew about this before, is what's called the beverage curve. Now, this is what we're talking about. If you listen to Jerome Powell's testifying, or not testifying, but you listened to him last week in the FOMC meeting answering questions, this is what is a important curve in economics. And it's called the beverage curve. Not something you drink, but it's a beverage curve. As unemployment goes up, the job openings goes down. It's a negative correlation here, which makes sense. As unemployment gets higher, there's less job openings. Makes a lot of sense. And again, here's all the years from 2000 to 2019, all these data points here you're looking at. And it shows that it follows this like negative growth here, right? Or this negative trend, I should say, not growth. Take a look at the beverage curve that we have right now. Look at this point. Like, again, the curve should be a nice, like, swooping curve down here. Look where we're at. Not only do we have a lower job opening rate, we also have a lower unemployment rate. So we were like way out here as of April when I made this post here. What's going to happen as a result? Well, in order to get back to this, either you're going to create more jobs to get back to that curve, or you're going to push unemployment's going to go higher. And likelihood is unemployment's going to go a lot higher because that's usually what happens. It's very much harder to create jobs compared to having more people that are unemployed, right? Business could just be laying people off and quitting, those kind of things. AI could be a huge thing where people get laid off because AI could do it for a fraction of the cost here. So chances are that unemployment is probably going to be the thing that's going to push higher here to then get back into this nice beverage curve that we're looking at here, which again, if unemployment goes higher, that means the labor market's turning over, which means that we need to act fast as a result. So very, very interesting things to talk about here. And before we leave for today here, the last thing to talk about is, I didn't even know this until I got a notification on Yahoo Finance. Jerome Powell is going to congressional grilling over Fed's ready to hold. So he has to now he's going to be going to Congress to talk about why there's no rate cuts and how to basically defend it, ignoring his percent college for lowering borrowing costs. So he has to defend to lawmakers why we have kept rates steady and why we're going to continue to hold until at least September. So something very, very interesting to be on the lookout for. I'll be curious to see what Jerome Powell says. You can read this article here. Again, 2 Fed governors. Hey, look at that. We're just talking about having a rate cut in July. The Iranian conflict basically has hopefully been subsided, which is great. It's going to be just a very interesting meeting that I would love to hear what Jerome Powell says. So, longer video, a lot of things going on here, but just kind of recapping after he's made this far in the video. We got the ceasefire in the Middle East, great. Keeps oil prices hopefully stable, which is great for us. We don't want this trade to be closed down here. We have 2 Feds that want to have rate cuts, Waller and Bowman. Data is showing that sales are going down and people aren't spending as much, which means we need to start cutting rates now. They want to have at least 1 cut in July and then kind of see what happens as a result. Unemployment is starting to tick up again. The possibility of rate cuts are going up. And Jerome Powell is going to Congress to talk about what's going on here. So hopefully that summarizes everything. And if you made this far in the video, feel free to like the video and subscribe to the channel as per usual. We hope you guys make it money in the market, and we will see you guys in the next video.